Welcome back to the ASC 842 Lessee Accounting series from PNJ Group. Section 4 covered ongoing measurement once you have a lease on the books. Section 5 addresses three areas that require judgment beyond routine accounting: the practical expedients that simplify a SC 842 work, the rules for accounting when a lease is modified, and the special analysis required for sale-leaseback transactions. After this section, you will know all 6 practical expedients, who can use them when they apply, and what PNJ recommends for each. You will understand that expedients are policy elections, not transaction-by-transaction choices. You will distinguish between a modification that creates a new separate lease and one that simply triggers a remeasurement of an existing lease. And you will be able to work through a sale-leaseback analysis, including the gain deferral that applies when a transfer qualifies as a sale. Practical expedients exist because the FASB recognized that full SC 842 compliance for every lease, on a lease-by-lease basis, would impose significant cost on companies with large lease portfolios. These are optional simplifications. You do not have to use them, but if you elect one, you must apply it consistently across the entire class of assets to which it applies. You cannot cherry-pick within a class, and each election must be documented in a written policy. Some expedients were only available at transition, the package of 3, for example. Others, like the short-term lease exemption, apply on an ongoing basis to new leases entered after adoption. 6 expedients are available. The package of 3 was a transition-only election that preserved prior SC 840 lease classifications, avoiding the cost of reevaluating every existing lease. The short-term lease exemption excludes leases with a term of 12 months or less from the balance sheet. They are expensed straight-line like old operating leases. The portfolio approach lets you group similar leases, say, all identical vehicle leases, and calculate one amortization schedule instead of hundreds. The non-separation election keeps the full bundled payment in the lease liability rather than separating the service component. Hindsight was another transition-only option, allowing you to use after-the-fact knowledge about whether renewal options were exercised. And the risk-free rate election is available only to private companies as an alternative to IBR. PNJ's handbook provides specific guidance on each election. The package of 3 transition expedients should generally be elected. Avoiding reevaluation of all existing leases saves enormous effort. The short-term lease exemption should be elected for asset classes with short-lived leases, like small equipment or month-to-month agreements. The portfolio approach makes sense when you have 10 or more similar leases that can be grouped. The non-separation election is particularly useful for real estate, where separating landlord services from the lease component adds complexity with limited benefit. Hindsight, however, adds complexity rather than removing it. Avoid unless there is a specific reason. And for private company clients, the risk-free rate election eliminates the IBR memo burden, though at the cost of a larger balance sheet. A lease modification is a change in scope or consideration that was not contemplated in the original contract terms. This is different from changes that the original contract already anticipated. If the original lease says rent adjusts by CPI annually, that CPI adjustment is not a modification. Similarly, FASB provided a practical expedient during COVID-19 allowing rent deferrals to be treated as if they were contemplated by the original terms. Those are not modifications either. Every true modification requires an analysis to determine which of 2 accounting paths applies. Is this a new separate lease, or is it a remeasurement of the existing lease? The modification analysis turns on 2 questions. First, does the modification grant the lessee an additional right to use an asset? Second, is the standalone price for that additional right commensurate with the market? If yes to both, it is a new separate lease. Account for it independently, with no change to the original lease. If the modification reduces the scope, say, the tenant gives back 30% of the lease space early, you remeasure and recognize a gain or loss. If the modification changes the payments or extends the term without a scope change, like a rent increase for an extension, you simply remeasure the liability at a new IBR and adjust the ROU asset upward or downward. In all cases, document the analysis. Sale-leaseback transactions have a specific logic. An entity sells an asset and immediately leases it back. These are common in real estate. The critical first question, which determines everything, is whether the transfer actually qualifies as a sale under a SC 606, the revenue recognition standard. If the transfer meets the criteria for a sale, derecognize the old asset, recognize the proceeds, and record a new ROU asset and lease liability for the leaseback. But here is the constraint: you do not recognize the full gain immediately. The portion of the gain that relates to the right you retained through the leaseback is deferred. If the transfer fails the sale test, keep the asset on your books, recognize the proceeds as a financial liability, and treat the leaseback payments as interest and principal on that liability. No ROU asset is recognized. The sale test is a substance over form analysis. A genuine sale means the buyer has taken real control of the asset. They can direct its use. There is no obligation or option to repurchase at a fixed price, and the leaseback term is short relative to the asset's remaining life. Indicators that the transfer is actually financing, not a sale. The seller retains effective control through the leaseback terms. There is a fixed price repurchase option below fair value, which is essentially a guaranteed buyback. Or the leaseback covers so much of the asset's remaining useful life that the buyer never really gets to use it independently. When the sale test fails, the economics of the transaction are really those of a secured borrowing, not a property sale. 3 important simplification and judgment areas in one section. Practical expedients reduce compliance burden, but only if they are elected as documented policies, applied consistently by asset class, and disclosed. Lease modifications require an analysis that asks whether the change creates a new right at a market price or simply changes an existing arrangement. The answer determines the entire accounting. And sale-leasebacks require a careful sale test under a SC 606. If the transfer qualifies as a sale, you derecognize the asset and defer part of the gain. If it fails, you have a financing arrangement with no sale and no gain. In Section 6, we bring all of this together in journal entries, one scenario at a time. Thank you for completing this section on practical expedients, modifications, and sale-leaseback transactions. Thank you for watching. Subscribe for more training from PNJ Group.